Ladies and gentlemen, good day and welcome to Jindal SAW Limited Q2 FY26 earnings conference call hosted by ICICI Securities Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Singh. Thank you, and over to you, Mr. Singh.
Good afternoon, everyone. Welcome to Jindal SAW Q2 FY26 Concall. From the management side, we have with us Mr. Narendra Mantri, Chief Operating and Financial Officer, Mr. Vinay Kumar, President and Head Treasury, and Mr. Rajiv Goyal, Senior Vice President, Corporate Finance. Without taking any much time, I'll hand over to Mr. Vinay Kumar for his opening remarks. Over to you, sir.
Thanks, Vikas. So, good afternoon, friends. Wishing you all a very happy Diwali and blessed festival season. I now welcome all of you to the investors call of Jindal SAW Limited for Q2 of FY26. On behalf of Jindal SAW management, we extend our sincere thanks to ICICI Direct for hosting this call. The Board of Directors formally approved the unaudited financial results during its meeting on October 17. The results have been released to the stock exchange in compliance with the regulatory requirements. Hope you would have had a chance to look at the results. Now, I will provide an update on the operations of the company, subsidiaries, etc. As you would have seen, the second quarter of the current year saw significantly weaker performance compared to both the prior year and the preceding quarters. And the prognosis of Q2 is we are providing as under. The overall macro level indicators in domestic and export markets remained robust. The company has recorded one of the highest order books specifically for the water sector, which means the company has secured large number of future projects related to water infrastructure, reflecting strong visibility. This is a positive indicator of the company's growth potential. The total volume of order book for pipe business increased to 19.25 lakh tons in September 25 as compared to 15.60 lakh in June 25. We believe that this is the highest order book what we have seen in so many years for Jindal SAW. Among our recent achievement is a new export contract for the supply of approximately 622,000 metric tons of helical pipes for a water-related infrastructure project in Kingdom of Saudi Arabia. Manufacturing for this specific order is slated to start sometime in Q3. We are running into Q3. The margin of this order are in line with the other export business of helical pipes. The company has commenced the trial phase of its new seamless piercing mill with commercial production slated to be in this quarter sometime next month because this is a technological product and the stability takes time. But we expect that the operations can commence or commercial operations can commence in this quarter. This expansion is projected to increase the seamless production capacity by approximately 150,000 metric ton per annum. Our DI facilities in India are fully committed for the foreseeable future with a current backlog of 1 year. Thus, although the wider markets were robust, but extended payment cycles from the water infrastructure EPC companies in India have severely impacted the cash flows and operational stability of pipe manufacturing suppliers like us. The protracted payment timelines often associated with the government-funded water projects present significant liquidity and project management challenges. We recognize that the current uncertain environment will have an effect on our operations and financial outlook. However, we are managing our strategies accordingly. Overall, our business faced significant challenges during Q2, which limited our performance. While export and domestic market demand remained robust, however, tight liquidity and prolonged rain spells hampered our operations and financial results. These factors were the main contributor to lower output, decreased sales, tighter margins, and a rise in inventory. Now, we believe the current situation is expected to be of short term. We gain our confidence from the historically high order book, healthy liquidity position of the company, and disciplined debt management. The company maintains robust working capital lines to effectively manage all operational requirements. Now, let me address the financials of Q2 and H1. Of course, you have got the result, but still, to repeat and do recapture. On the standalone basis, the company recorded total income of rupees 3410 crore as compared to rupees 3327 crore in Q1 of FY26 and rupees 479 crore of Q2 of FY25. The EBITDA for Q2 FY26 is reported as rupees 335 crore as compared to rupees 560 crore in Q1 FY26 and rupees 875 crore in Q2 of FY25. The PAT for Q2 FY26 is reported as rupees 79 crore as compared to rupees 364 crore in Q1 of FY26 and rupees 477 crore in Q2 of FY25. On consolidated basis, the company recorded total income of rupees 4264 crore as compared to rupees 4103 crore in Q1 FY26 and rupees 5602 crore of Q2 FY25. The EBITDA for Q2 FY26 reported as rupees 482 crore as compared to rupees 688 crore in Q1 FY26 and rupees 944 crore in Q2 of FY25. The PAT for Q2 FY26 is reported at rupees 138 crore as compared to rupees 415 crore in Q1 and of FY26 and rupees 475 crore in Q2 of FY25. So the standalone operations have suffered, but consolidated operations have shown improvement, especially from the UAE operations. The net debt of the company on standalone basis has increased to rupees 3,310 crore as at 30th September as compared to rupees 3,088 crore as at 30th June 2025. The long-term debt is approximately rupees 550 crore only. The net debt of the company on consolidated basis has increased to rupees 3,856 crore as at 30th September 25 as compared to rupees 3,484 crore as at 30th June 25. The long-term institutional debt is only rupees 742 crore on consolidated basis. Now to summarize, predicting the near to long-term outlook is difficult at this point of time as the business environment is affected by persistent geopolitical challenges and delays in the government funding, etc. The company's order book has strengthened significantly and continues to be strong, with new orders secured across all business segments. We are also receiving positive market inquiries from both domestic and export sectors. The order book status sets the stage for a progressive strengthening of operations and financial results starting from Q3. We have a very comfortable long-term debt position. Our standalone long-term debt is roughly rupees 550 crore, of which 500 crore is tied up to an NCD with LIC that will be redeemed in the 2028 to 2030 period. Working capital usage is directly influenced by our business operations and the broader business environment. We are optimistic about seeing improvement in this area as well. In view of this, we may expect gradual improvement of operational and financial performance from Q3 onward. Now, let me discuss something about our subsidiaries and joint ventures. In our Abu Dhabi operations, the entity has done well as compared to previous quarters. It recorded sale of approximately rupees 607 crore in Q2 as compared to rupees 525 crore in Q1 of FY26. And the order book of Abu Dhabi operations stands at $235 million, corresponding to approximately 215,000 metric tons of ductile pipes. And this gives a visibility of 3 to 4 quarters. And now this is over and above the order book of approximately 19 lakh ton of what we have discussed earlier for Jindal Saw. In USA, company has marginal operations which remains profitable in Q1. Total revenue was rupees 173 crore in Q2, which is marginally lower as compared to Q1, where the income was rupees 188 crore. But US, we have only small operations, so it is not, in terms of percentage, that meaningful. We have a joint venture with Hunting, which is Jindal Hunting, and this joint venture has contributed rupees 9.4 crore in Q2 for this financial year, as compared to rupees 9.5 crore. So the performance remains flat. But in previous year, corresponding previous quarter or previous year, it was 6.8 crore. So this year we are doing better, let's say 10 crore approximately every quarter. Some update on JITF versus the legal suit with NTPC. Now, some arguments took place in the last hearing in presence of in front of the Honorable Double Bench of Delhi High Court. The bench has given another date, which is on 27th October. If the continuous hearings happen, we can expect some pronouncement in this financial year. But rest will depend on how the parties respond and how the date goes on. In terms of our some updates on the new projects which are announced in GCC MENA region, like in the steady move to align with the shifting economic landscape of the GCC MENA region, Jindal board approved 3 new manufacturing projects in June 2025. These nations are actively pursuing economic diversification away from oil and prioritizing local manufacturing, a trend Jindal is proactively addressing. As a long outstanding supplier and an existing Abu Dhabi-based DI pipe manufacturer, this expansion strengthens our competitive position in these key markets. The investment includes a new seamless pipe plant in Abu Dhabi, a helical pipe facility, and a DI pipe finishing line in Saudi Arabia. These projects may be completed gradually in next 2 to 3 years, and we will be consolidating these with Jindal SAW Limited. Now, subsequent to these projects overview shared during our last few investor briefings, we are now actively engaged in key development stages. We are currently finalizing agreements with potential partners, joint venture partners, and advancing the formal incorporation of the new companies. Concurrently, we are focusing on securing land and finalizing the financial closures for each of the projects. Now, with this, I leave the floor open for interactive discussions. Mr. Narendra Mantri, our Chief Operating and Finance Officer, and Mr. Rajiv Goyal, Senior Vice President, they are with me, and we are happy to take the questions from the investors. Over to you, Vikas.
Thank you.
Thank you, sir.
We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. The first question comes from the line of Sailesh Raja with B&K Securities. Please go ahead.
Sir, thanks for the opportunity. Sir, we have an export order backlog of 8 lakh tons, which includes 6.2 lakh tons of job work. So you mentioned during the call this is entirely for HELSA pipes. So typically, our HELSA order are fully export oriented. So should we understand that balance 1.8 lakh tons pertain entirely to HELSA, or it will be a mix of both HELSA and HELSA? Because if it is a mix, then it appears that visibility of HELSA is quite limited. So could you please give clarity on this?
Okay, so let me answer the question in a different way. I'm sorry I could not fully understand the question, but let me answer the question in a high level so that it includes, let's say, a couple of subsets of the question. So we have in totality, we have, let's say, in the pipe sector, we have order of 19,25,000 tons. And this includes exports of approximately 30 to 32%. Now, the helical pipe order for water sector to KSA is 6,22,000 tons, which represents roughly, I think 12 or 13%. So there are orders from for longitudinal pipe. There are orders for export market for longitudinal pipe, for other helical pipe, even seamless pipe. Now, this is why we mentioned this order separately, is that this is a export order and this is a job work order. So eventually in the job work order, we are not buying the steel only. Rest of the things are included in this. And I mentioned in the briefing that in terms of margin, the margin are comparable to the export business of, let's say, helical or even longitudinal. So we have order book for export, which is varied, which is for every product.
Sir, still it is not very clear. You said in the presentation it is mentioned that the 9 lakh tons, that includes 6 lakh tons of job work, right, sir?
Yeah.
Also in the presentation it is mentioned that the overall exports order is 8 lakh tons. So in this 8 lakh includes 6 lakh tons of job work.
Yes, correct.
So the balance is only to 1.8 lakh tons.
Yes, which is longitudinal, helical, as well as some portion of seamless. And in fact, we have a ductile order also.
So in this case, then the ELSA visibility is very less. Okay? That is my question actually.
So you want to understand the quantity. Yeah, you want to understand the quantity of the rest of the product.
The quantity, just wanted to know the visibility of ELSA pipe.
Okay, so let's say very quickly, the longitudinal for export, longitudinal is close to 1,15,000 tons for export purposes, which is oil and gas. And this is longitudinal, where is the ductile and all? And and approximately 60,000 ton for export is for ductile and seamless.
Okay, sir. Got it, sir. My second question, if you see the GP to gross profit to EBITDA conversion in this quarter, it stands at only 24% on the standalone basis. So because of lower volumes, our utilization level is very low at 3 lakh tons. So that's why it's low at 24%. But if you see last year, we have done around 4 lakh tons and our conversion rate, that is gross profit to EBITDA, it is 40%. So assuming that it is normalized, at normalized level, we can do around 40%. Is there any scope to improve the conversion rate going forward, both to mitigate the impact that we are seeing currently and also to enhance the financial metrics once the recovery begins? Because if you see the competition, some of the competitors are reporting 45, 48%. So is there any scope to improve this conversion rate?
So let me put it. Okay, good. So let me respond it in this way. Now we have the capacity. Okay, if you see the last year we did close to 2 million ton of sales. Okay, close to 2 million ton of sales.
0.86.
Yeah. I mean, okay, and we already have the order book of similar magnitude broadly. Correct. We have the capacity, we have the capability to execute the projects. I'm talking about the standalone. We have the capability and capacity, and it has been already demonstrated, number one. Number two, over last 1.5 year time, we have worked on increasing the capacity in seamless, where the trial operations have started, and we mentioned that the capacity would go up by another 150,000 tons. So we would be ready in future to take more business in seamless for oil, gas, and other industrial products. So to answer your question in a way that these are the extraordinary circumstances and which we keep seeing after every 3 to 5 years time. If you remember, 22-23 was a very challenging year when the commodity prices were going like anything. It was I mean even the NSE, BSE are not going the way the commodity prices were going. Then the coking coal had moved from $150 to $500, and iron ore price had also moved accordingly. And again, we had a serious challenges in terms of managing the inventories, and the business operations and financing and liquidity and everything. Today, the scenario is different, primarily because of, let's say, liquidity, which is controlled by the, let's say, the federal and the state governments, where the orders are there, business opportunities are there, orders have been issued by the government or, let's say, the end user to the EPC or directly to us. But because of liquidity, as I mean, you will be hearing it from everywhere, because of liquidity, there is a backlog. So we can only speculate, but we understand from the market scenario that it might take couple of months before the normalcy begins. Now, when the normalcy begins, presume next year. So if everything works well, we might come back to what we were doing in the last 2 years. Rather, we can improvise it because, and I'm saying it from the perspective, the orders are there. There are inquiries. The capability is there in terms of manufacturing facilities, and we have invested and we are investing and we are doing a lot in terms of cost optimization and rationalization.
Okay, sir. Great, sir. Sir, one last question. So after a gap of 10 to 12 months, several state governments, they have recently announced large projects. If you say on 14th October, I think Gujarat, they have announced 16,000 crores worth of order under the Amrut scheme. And also, I think 2 days back, Andhra government also announced 10,000 crores of order. And Odisha also, I think 4 or 5 days back, they have announced 1,700 crores for the river linking projects. So are we participating in any of these projects? So what are at what stage we are in the bidding or qualification process? Can you please explain that?
Yeah, Mr. Narendra Mantri would respond to this.
I must say that all these things are very recent. The tender will come in due course of time, and definitely we will be participating in all these orders, in all these tenders. But again, from the announcement to the actualization, we think that there will be some time gap. That is why we are saying that the improvement from where we are currently will take some time. And at this point of time, I can only say that we will be doing, hopefully, we will be doing better than the Q2 in Q3 and Q4.
Okay, sir. All the best, sir. Thank you.
Thank you.
Thank you. Next question comes from the line of Praveen Agarwal with IVP Engineers Private Limited. Please go ahead.
Yeah. Good afternoon, everyone, and once again, happy Diwali to all participants and executives of Jindal SAW. See, my question is, we have seen numbers, financial figures. How was the production in Q2 as compared to previous FY Q2? How did we increase or reduce, or was it more or less same? How were production figures?
Say because of lower offtake, the textile iron or the water sector, we have controlled the production also, and that is why the production was lower in Q2 as compared to Q1.
Okay, so you don't have things stockpiled in inventory. It was lower offtake was met by reducing the production quantity.
No, I'm not saying that inventory has not piled up because the decision making takes certain time to reduce. In fact, if you have seen our balance sheet, there is an increase in the inventory level, but this will be corrected in Q3.
Yeah, I understand. And how this has affected cost per ton of pipe or material, your output in this quarter Q2 vis-a-vis previous year Q2?
Because of the cost only, we have shown this kind of result. You can understand this.
I understand. Fine. Okay. Thanks for your answer.
Thank you. Next question comes from the line of Radha with B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question is that the 6 lakh tons of job work orders, how much execution are you expecting in FY26? And in your opening remarks suggested that margins in job work will be good. So assuming current pricing scenario, is it fair to assume that at least 500 crores of EBITDA can be done from execution of the entire 6.2 lakh tons of job work?
Okay, to answer your first question, we should receive the first consignment of steel in next 1 or 2 weeks' time at our factory. Number one, so the production would start in this quarter itself, and we expect that in this remaining part of the financial year, we should be producing close to 125,000 to 150,000 tons. And the shipment and sale would depend on coating and the availability of ships. That's one. In terms of EBITDA, we don't want to, let's say, put an exact number, but what we have said that the profitability based on the current estimate and based on the quotations, quote profit given, because this includes the transportation cost also to site of the buyer. The profitability would be similar to what we get in normal export orders. So it will be better than the domestic business.
Okay. And for the working capital requirement of job work, is it fair to assume that it will be 20 to 30 days lower compared to manufacturing?
No, so basically because it is job work, so steel is not being procured by us. We will only be procuring only the coating material. So this will be the steel is not on our account. So there will be no inventory on account of steel in this order.
Yes, so that is why I was asking that overall net working capital cycle should be at least 20 to 30 days lower compared to if we would have done manufacturing for the same quantity. Considering the inventory position, just asking.
In totality, yes. If you look at from this perspective.
Okay. Lower by 20-30 days or much lower than this?
No, it's difficult. Eventually, this will depend on how we are executing the order, because we would be committing maybe initially one facility, subsequently second facility. Also depending on how we are getting the consignment, because the steel is being supplied by the buyer. So it is meaningless for us from this perspective that how much inventory would be there, because the inventory doesn't belong to us. But if you are saying that in overall in blended side, whether inventory will be lower as compared to the sale, it will be lower. But in the sale,
overall working capital.
Yes, overall working capital, that's the thing. Overall working capital you have to measure with something. So if you are measuring the overall working capital with the sale will include only the job work charges, not the sale of the total pipe.
Yes, sir, I understand that. So that is why, since it includes only the job work charges, that's why I'm taking at least lower by 30 days, because inventory will not be there. So is this the right understanding?
You can consider it.
Okay. Second question is, I wanted to appreciate, despite the challenging situation, the gross profit per ton on pipes has been good in this quarter. So I just wanted to appreciate because of the mix has been maintained by the company. So with regards to this, until there is a revival in government capex, are there plans or opportunity to export more of DI pipes from India either to the Middle East or to nearby regions?
Okay, so see, we have a very different kind of let's say situation, because we are already present in Middle East, where we have a manufacturing plant in Abu Dhabi. So what we focus on in the export market from India are the products which our Abu Dhabi factory is either not producing or they are full in that particular site. So for example, we already have a export order for ductile, which is going to again MENA region, but that is a size which our Abu Dhabi facility is currently not producing. So we would be eventually not competing with our Abu Dhabi, we'll be rather complementing that. Having said that, we are looking at various geographies across the globe, wherever Indian pipes can go, which are at this point of time are not subject to anti-dumping or whatever. So we are looking all possible opportunities. That is the role of the marketing, to see beyond their regular areas and the geographies. It always remains there, and that is why we get the order, and we have a better position because we can reach out from India as well as from our UAE operations.
Okay. So actually, I asked this because a follow-up question with this is that Saudi has started a probe on anti-dumping duty on DI pipes from India. So just wanted to understand with respect to that, what is the total demand of DI pipes in Saudi, and what percentage of Saudi demand is being catered by imports overall, and how much of it is coming from India?
Okay. You are aware that we are putting up, or we have started working on putting up a ductile iron plant in Saudi, considering which is a finishing line, considering the demand there. You are right that there is an anti-dumping investigation there. But again, we have said from India, we are only supplementing our Abu Dhabi plant for the sizes where that plant is currently not in a position to supply. So we will be either through our subsidiary or the sizes which are not in a position to serve through Abu Dhabi. We are focusing in Saudi only for those sizes. But other than Saudi, the GCC market and MENA market is much bigger, and we are trying to supply more on the export side for our ductile iron facility in India.
What is the market size of GCC?
It is very, actually it depends upon the project's announcement, and we are hopeful, say as far as the water pipelines are concerned, we expect lot of work all these countries are doing. So we at present, I don't have that figure currently with me, that how much is the current demand or what are the new projects that is coming. But considering the market potential, we have announced not only the ductile iron facility, but the helical pipeline also. For pipe manufacturing plant, we are putting up both the facilities there in Saudi. And you can see that one single order we have received from that country for 6 lakh ton for helical.
Yes, sir. So lastly, for modeling purposes, I wanted to understand how much capex should we take for FY27 and FY28?
From India perspective.
Yeah, growth
capex in Saudi?
Growth and maintenance.
For maintenance capex.
So on Jindal SAW perspective, the maintenance capex remains in the range bound manner, maybe 600 to 700 crore rupees, considering the various locations all across India, roughly 12 locations, and things are moving on account of efficiency and debottlenecking. So you can take roughly 600 to 700 crore annual capex, maintenance capex from Jindal SAW perspective.
Mm-hmm. And growth capex, sir?
Growth capex.
Growth capex.
So growth capex is something in India. We are not looking for any growth capex per se, other than this seamless activity where we put that additional piercing line, which is now under trial run. So capex would be over maybe in the coming quarter only. So beyond that, we are not looking for any growth capex in India, Jindal SAW.
in coming quarter?
So in coming quarter as well as in coming years and FY27 and 28. As of now, there is no growth capex on board.
Yes, I wanted to understand the bifurcation of this 3,600 crore capex. How will it be divided between FY27 and FY28?
So FY26, in general, rather, we are doing maintenance capex in the range of 600 to 700 crore rupees annually. And if you are talking about the new capex, growth capex, Jindal Saw perspective, where all the three projects, two in Saudi, one in Abu Dhabi, that is something you can take broadly. 27 would be 40 to 50%, and 27 again 28 40 to 50% roughly, based on our present estimates.
Understood, sir. So last question. So, sir, in Oman, for the Farhud-Suhal Loop Line project, as per the media articles, Jindal Saw has received 193 kilometers of pipeline project, which is expected to be executed in the next 24 months. So one is that, is it included in the current order book? And is it fair to assume that these are for the longitudinal saw pipes, and we can do at least 50 crores of EBITDA from this project?
So this order has yet not been finalized to our understanding. These discussions are going on.
Is it for ELSA, sir?
So it will be the primary ELSA, but there could be a mixed also.
Okay, sir.
But it has not, nothing is finalized. It's not included in our order book.
Understood, sir. Thanks and all the best to you.
Thank you. Next question comes from the line of Rajesh Agarwal with Manure. Please go ahead.
Hello? This quarter the margins have come down. It is because of volumes, or there is any other one-off?
The margins primarily is a function of, let's say, the production quantity as well as the cost. Because the overall production and the sale remained low, so eventually absorption overheads and all those things, the margins are low accordingly. So we don't expect that, while we believe that this quarter onward situation should improve, that is in terms of overall business as well as the profitability.
So this quarter margins also will come back to the old margin?
No. So that will be a gradual thing, because the fall can be sudden, but the improvement will be gradual.
Okay. It is not because the job work has lesser margins, no?
Come again, sorry?
The job work doesn't have lesser margins than the production margins, no?
No.
No. Okay. The margins are same. And second, how is the outlook for the DI pipes in India? The old payments are getting released, and any new tenders?
So as you can see that we mentioned that our capacities in India are booked for a year. Practically, we have order book of 7 lakh, approximately 750,000, and we have a capacity of approximately 7 lakh. So orders are not a problem. The problem is like the liquidity issue, because it's a supply chain. We are the last person in the chain. We supply to EPC or directly to the government. 80% of our business is through EPC. Now EPC is waiting for the money for almost 1 year, and that's where their business has also gone slow. Now eventually the governments are working out through the state governments. Let the state arrange the funds and start releasing the funds to the EPC and to the let's say the pipe suppliers. It will be a gradual process. As we said, as we believe that the disbursement of 50,000 crore will not happen immediately, but now the business will start, and with some hiccups back and forth, we can believe that maybe in 2 or 3 months' time the business might come towards normalcy.
So can you quantify the dues from the EPC contractors? How much dues?
80%, 90% business is through the EPC. I mean, we don't have the numbers right now for the receivables and all, but 80-90% business is to the EPC, and that is the norm world over.
And sir, how is the outlook of the oil and gas in Middle East? Abu Dhabi and
See, the Middle East. Okay, so there are two things. One is the scenario of oil and gas. Second is the scenario of the pipe business for oil and gas. Typically, the oil and gas business is a regular business for the Middle East or world over. The issues relating to India buying from Russia or production costs going up and down, it really does not impact the pipe business very significantly, because pipe is the last thing when somebody is putting announcing the new pipeline. So this does not impact the pipe business very significantly. It could impact, let's say, if let's say the pipe, the oil producing countries are becoming, let's say, cash deficient, they may defer their capex, which happened, I think, 5 or 6 years ago. But at present, they are making decent amount of money by sale of the oil, which can improve actually further. So there is no impact on the new pipe demand. The only thing is how they are planning the new pipelines and when these orders are coming in. Secondly, now everybody is focusing on the indigenization, and they might be maybe 2, 3, 4 years down the line, they would ask the global investors and all to put up the facility in their countries. So there will be a paradigm shift in next 3 to 5 years time globally.
Okay. So the imports will not come to Middle East, you're feeling, Saudi and all. So you'll have a better opportunity.
The imports will happen, but gradually this will reduce. And that is where the producers have to, let's say people like us or others, they have to focus, like if you have to be in the market, then you be present there also, or you lose that market.
So there are our growth capex which we announced for the 3 projects, that will continue as usual, or there's a thing over it?
No, so as of now, what we have announced in last 6 months time is one project for seamless pipe is in Abu Dhabi. One project of helical pipe, which is primarily for water sector, is in Saudi, and the DI finishing facility only, because we have a full-fledged DI plant in Abu Dhabi. So to sell in the domestic Saudi market, we are planning to do finishing there. So as of now, these 3 projects have been announced, and we are working on that.
So how will this means of finance, how will this capex cash flow will be met?
So this is like these projects will take 2 to 3 years time to, let's say, set up, because these countries are very slow in terms of let's say doing the things. And we mentioned that close to 350, let's say 400 or 425 million dollars in all put together for the project, where the equity would be approximately 30%. In 1 or 2 small projects, we have a joint venture partner. In totality, we may require only $120 million of equity over next 3 years' time. The rest will be the debt on project, which will be from the local market.
Thank you. Mr. Agarwal, please rejoin the queue for more questions. Next question comes from the line of Shweta Dikshit with Systematics Group. Please go ahead.
Hi, good evening. Am I audible?
Hi. Yeah. If you can be louder, that will be helpful.
Sure. Just a second. So, a couple of questions from my side. Starting with the seamless pipe plant, we've started trial productions there. Any outlook or guidance that what is going to be the quarterly number for 3Q and 4Q, which we are looking at, and what is likely going to be the capacity utilization over FY27?
So, Shweta, in terms of seamless, we did roughly 2 lakh plus in FY25, and by putting up another piercing mill, we would be able to increase the production capacity roughly 1.5 lakh ton additional. So from Q4 onward, we can see annually the production levels may increase from 2 lakh plus to 3,50,000 something. So that is something which you may see numbers in the coming quarters.
So that's roughly, if you look at, I mean, the quarterly run rate still comes to be around higher than close to 90,000 tons of quarterly run rate that we're looking at from 4Q onwards?
Yes.
Okay. Secondly, on the new projects that are announced for the MENA region, I do understand you said there have been regulatory delays in these regions, but any part of the CapEx that has already been spent, or what is the status of these projects exactly?
Shweta, in terms of amount spent, as of now, we are in the process of identification of the vendors and land acquisition and all. So not much amount has been spent, if we say, let's say, as of 30th September. Hardly anything. Okay, that's one. But when we say that these territories take time, primarily because of not many things are well defined as compared to the other countries, even including India. So, and we have experience of setting up a project in Abu Dhabi. We include certain delays in our execution cycle, and that is why we say like the project can be executed in a period of 2 to 3 years time. So, having said this, these things have been factored. Working is being done on parallel basis in terms of joint venture agreements. We have started finalizing those in terms of land identification, so that is a long lead item in terms of identification of the vendors, so that we can immediately, the moment we are in the process of incorporating the companies, the moment the companies are incorporated, bank accounts are open, we can start placing the orders. All these things are happening. So I believe that this year, by the end of this financial year, which is March 26, we would be in a position to, let's say, place the orders for the equipment. The companies would have been incorporated, land would have been acquired, because everywhere these are leasehold lands, unlike in India where you have the freehold. So broadly, from there you add, let's say, 2 years plus when the production can start. So 27 and 28. Starting 28, 29, we can have some operations in the seamless facility as well as in the helical facility. Ductile can start earlier because that's only a finishing facility.
So my question again comes back to the point, when we talk about the seamless that is existing that we're doing, even having this being a brownfield expansion has taken quite some time. Then having a similar project of the same scale, setting it up in a greenfield capacity, it seems unlikely to be, generating, in fact, operationally contributing in FY28.
So 27, 28, I said that 27, 28 is the period of implementation. So nothing will come in 28, FY28, because 26 we are completing. So, right, so 28, 29 also, we expect that partial operations can start in seamless and in helical. Now, to answer your question that they are because these are the greenfield projects for this. So, greenfield projects can be actually faster also in terms of implementation, because in the brownfield projects where you are doing expansion and all, you have to do a lot of accommodation within the same premises and doing all those things. So it is, let's say, adding a floor onto a house or creating a new house. So adding a floor is more complicated rather than making a new house. So having said all these things, we don't expect any contribution from even sale or profitability from seamless and helical in 28. 28, 29, we can expect some production and contribution. I mean, profitability we can't count right now, but we can, of course, and secondly, in case of seamless, there will be a process of approvals and accreditations from the different authorities and the buyers and all. So that is also a process which we have to count. In case of helical, it might not be an issue.
But these certifications and approvals would run parallelly, or would it be one after?
It can only run once it can only initiate and start after the trial run has started, because the product will go into the approvals and it's a process, and there are not, unlike the ductile, when you have, let's say, huge market, in this case there will be very handful of the customers. So let's say the government approvals or the standards approval and the approval by the potential buyer. So this process will be parallel the moment the production commences.
And what can be the typical approval cycle here?
It's difficult to say because it's for this territory we'll be doing the seamless work first time. But I mean, if we hazard, let's say it could take 3 to 6 months time, maybe more.
Understood. And the last question, just your thought on this thing that Saudi is initiating anti-dumping investigation on imports of DI pipes from India. This is something which all the companies, at least the domestic producers, have been very positive about it. There's a lot of demand from that region. Now, what's the internal capacity over there? Is there a risk to this business overall from the overall industry perspective? What has been the reason why such a standard?
Let me answer it a different way. Currently, the domestic ductile capacity in Saudi is not much. Okay, so there are only 2 ailing plants. But having said that, both the ailing plants have some, let's say, stake from the government. So governments are, of course, they will try to protect them. Secondly, is that the Saudi government want that the manufacturing and the in-country value addition should happen in Saudi. So like they are following the Indian Prime Minister, they are following Trump, so they are also trying to do like you should do production in Saudi, and there are norms which they are setting up for the in-country value addition. So we will mark for that, and gradually they would reserve the domestic production facilities for giving a right of first refusal, giving protection for the tariffs, giving protection for pricing and all those things. It's a process which is happening in almost all the industries. Now, we won't like to comment on the, let's say, the initiation of the anti-dumping duty because we are a producer in Abu Dhabi. So we won't like to comment on that matter, primarily because, as you said, that there are Indian exporters to that, let's say, jurisdiction. So we will refrain ourselves from commenting on that matter because we are an interested party. We are supplying pipe from Abu Dhabi to Saudi. But Saudi has good potential for overall water sector, including the ductile pipe, including the helical pipe and other pipes. And because geographically they are expanding everywhere within Saudi.
And currently we are not selling much in Saudi market from India.
Thank you. Ms. Dixit, please rejoin the queue for more questions. Next question comes from the line of Bhavik Shah with Investor Capital. Please go ahead.
Yeah. Hello, sir.
Hi.
So my first question is, so we saw a decline in volumes in the current quarter, and it is mainly said due to the DI volumes being decreasing in domestic. So what gives us confidence so in the next 2 quarters these volumes will pick up? Have you seen any traction over there?
So, okay, so our confidence comes from the perspective. Let's divide the question in 2 parts. One is quantity, second is the price and the profitability. So there are basically some demand has started coming back from the domestic buyers, albeit it's a lower as compared to a regular demand, and where the discussions are happening that when the pipe can come and what will be the current terms and the pricing. So this is basically a opportunistic scenario for the buyers where they are trying to, let's say, renegotiate some of the positions. Now, state governments have been asked to arrange the funds and, let's say, start making the payments. So state governments are making their own arrangements and from the different multilateral and domestic institutions. So this is where basically we believe that the things are on improvement. The profitability can take last quarter, like it took a hit. The profitability can start improving from here. But as I said, like it is not like it has, because the profitability has come down from, let's say, above 15%, 16% to, let's say, in the range of 10%. The improvement will be gradual process. Good part is that we are a multi-product company. So if there is a problem in one product, the other product is taken care of, and this is kind of a hedge what we have. But in last 2 years, we saw that all the cylinders were firing. This year, 1 or 2 cylinders have having a challenge. So once the situation will start improving, we hope that we would come back to the same scenario, but it will not be in 1, 2 or 3 quarters.
Right. And so when we say our order book is of 19 lakh crores, of which 7.5 lakh crore you said is of DI pipes. So this order will get only executed as and when the payments get released. So ideally, what should we take as the execution timeline of this order book? Like when can we see this order book getting executed?
Okay. So, Bhavin, basically the total order book for pipe right now is close to 90,25,000 ton, in which the tile is about 7,50,000 ton, approximately 7,50,000 ton. Now, if I invite your attention to like what we were doing last year, FY25. FY25, first 6 months, we sold close to 330,000 ton ductile pipe, right? So annual basis, and that was the time when the Satwana facility had just started. So today we are capable, if everything is well, we collect money on time, everything is there. We believe that we can do 7 lakh or even more than 7 lakh ton of production and sale in India from all of our 3 blast furnaces. So the capability and capacity is there, which we have demonstrated in the past. Now the only thing is that we don't want to sell when we don't have conviction of collecting in time. So eventually every buyer is also having the same problem because they don't want to do additional work for the, let's say, the corporations or those unless they are paid for their old running bills. So this has become a bit vicious, and this is getting sorted out. But as you know, because a lot of chaos has happened in this process, so it will take time for, let's say, settlement of the invoices of their bills, and then they are making payment to us, and then they have to actually start working for the new project. So ये ट्रैफिक जैम हो गया थोड़ा सा, इसको जो है थोड़ा टाइम लगे क्लीन अप होने में.
Right.
And everybody is suffer for that. Even the government is suffer.
Understood. So what is the one-time write-off which we have taken, sir, in GITS? I think we were what my understanding was, we have already written that off and no cash outflow will be happening, right?
So this write-off. See, we are showing the comparative numbers. We are referring to our presentation, which we have uploaded. This was, I think, in 23 or 24, not in this year. This year there is no write-off. This year, even last year.
Okay, this year there's no write-off, right? Okay.
No.
When we say of the job work, we'll actually only recognize revenue to the extent of conversion, right? We'll not take the entire revenue and entire cost of goods sold. So our actual increase in revenue will not be much, right?
Yeah. So the total order value for this job work is, let's say, close to $190 million. So only that will be the income in the top line.
Okay, understood, sir. And so regarding the capex, you told 600 to 700 crore is the capex for FY26. So, sir, this is the consolidated capex, right? This will include investments in subsidiaries in Saudi and places, right?
No. So this is standalone. And the capex for the subsidiaries in Saudi and UAE will be on the top of it. In the current year, as we mentioned for the earlier question, up to September there is no meaningful amount which has been spent. We would see that what we can do in next 6 months' time, which will be, let's say, some advances to the supplier, some letter of credit to open, and some civil work. This year, we don't expect much, maybe $20-30 million, but next 2 years will be happening years, but that will be on the top of what we mentioned, 600-700 crore rupees, which is only for Jindal SAW India standalone, primarily because we have 12 facilities. We are trying some upgradation, modernization, some capacity improvement, bottlenecking. So everything we are doing parallel so that the impact should be seen when the situation improves.
So next year this India capex should be lower. Next year this India capex should be much lower, right?
I think next year also will be in the similar vicinity, but after that you can expect much lower capex in India because we don't have every day you cannot have the same maintenance capex. And also, as per our accounting, the ductile molds are also part of these capexes, which is actually not a capex, but this is how the accounting is done because the utilization or consumption of the mold is life based. So this also includes the molds which are used for pipe making for all across 3 locations in India.
Thank you. Ladies and gentlemen, that was the last question for today. Due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to Mr. Vikas Singh for closing comments.
On behalf of ICICI Securities, I would like to thank Jindal SAW management for giving us the opportunity to host the call. I hand over to Mr. Vinay Ji for his closing remark.
Yeah, thank you very much, Vikas and Chorus, and to all the participants on this call. We hope to see you in the new year FY26 for the next quarter's meeting, unless there is another announcement prior to that. Thank you very much for attending the call.
Thank you.
Thanks.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.